Hey, this is Thomas and welcome back. In this video, I will talk about some updates about RRSP this year and what are some best ways to utilize the RRSP so you can minimize your tax bills and maximize your long-term growth. As you probably know, RRSP are a huge subject, and with so much to cover, I've broken it down into two parts. First, I will go over the benefits of RRSPs, the contribution limits, and the rules you need to follow so you don't get penalized. And in the second part, I will go over the RRSP withdrawals and blind spots, and I will talk about what kind of investments to put into your RRSP to maximize your tax efficiency. Now, before we move on, please don't forget to like and subscribe this channel for more content on how money works in Canada. Let's get started. RRSP stands for the Registered Retirement Savings Plan, and it is probably one of the most important tax shelter accounts offered in Canada. Then they offer two main benefits. First, it allows you to defer your taxes to a future year. When you put your money into an RRSP, you'll be able to reduce the amount of taxes you pay this year and delay those taxes until retired. And at that point, you should have a smaller tax bracket, and so you will pay less in taxes. For example, say your taxable income this year is $100,000, and that puts you in approximately around 25% tax brackets. If you're a typical employee, your company will always deduct the tax part from your paycheck. Then in April, CRA will know that, oh, I need to tax you at $25,000, but you prepay me $30,000. Okay, I'm going to return you $5,000. Now, how RRSP kicks in is that if you contribute $20,000 into your RRSP this year, then your taxable income will become $80,000, which means we need to pay the CRA around $19,000 in taxes. And this is the interesting part, because your work usually don't know how much you contribute to your RRSP, so they will still going to deduct the same amount from your paycheck. So by the time it's April, CRA realized that, hey, you prepay me $30,000, but now CRA only need to take $19,000, so they're going to give back $11,000 instead of $5,000 as tax return. The second benefit is that your RRSPs allow your investment to grow tax shelter. This means any income you earn inside your RRSP will not be taxed until you take it out of the account. So any dividends, interest, or capital gain where you might need to pay the CRA every year, but now you get to defer it. This is huge because your investment will grow much faster inside an RRSP than they will in a regular account that will be taxed annually. The tax shelter nature of an RRSP is very similar to the tax-free savings account. The main difference is that with an RRSP, you get to reduce your tax today, and so you have more initial money to invest with. Yes, it is true that you still have to pay the tax eventually, but now you have the next 20 to 30 years to plan accordingly. In an RRSP, you can hold almost any form of investments like stocks, mutual funds, bonds, ETFs, and even cash. As long as these assets remain inside your RRSP, you won't be paying any tax on them. But hey, I want to stress this point, just because you can hold cash in your RRSP, but if you only put it in a regular savings account for a long term until you retire, you will earn at least best at 1%, which isn't even inflation these days. Yes, there are risks with investing into stock markets, but with proper planning, the income you earn from stocks and mutual funds will far surpass the 1% interest rate. Saving money on tax is great, isn't it? So the question you need to ask yourself is, how much money can you put into your RRSP? Your RRSP contribution room depends on your income every year. Your contribution room will increase by 18% of your earned income in the previous years, but is capped at a maximum value which was $29,210 this year. So if your earned your income was $60,000 last year, you will gain 18% or $10,800 of RRSP contribution room. If your earned income was $250,000 last year, 18% of that is $45,000, which is way above the maximum amounts, so that your contribution room will be still limited to the maximum amount of $29,000 plus all the carryover room. But what counts as earned income? It includes all your pre-tax employments, your net self-employed income, and any net rental income, and all considered as earned income. As an example, let's say your salary is $50,000 as reported on your T4, but you also Ubered on weekends, which got you $10,000, but you paid $2,000 in gas. which would count as expense. Your net income from Ubering would be $8,000, and let's just say you rented your basement out and made $18,000. And if you add all these together, you get an earned income of $76,000. Now take 18% of that total and your RRSP room will be $13,680. Now, a lot of people won't be able to contribute that much to their RRSP, especially if they have a young family or they're just starting out in their career. So let's say they can only contribute $6,000. The room that is left, the $76,80, would carry over to next year. Maybe next year you don't have to pay for daycare, you get a raise and able to contribute a little bit more. Or you can use it to offset huge capital gain like selling an investment property. If you make any RRSP contributions, that amount will decrease your available room. This is important to remember because if your employer offers an RRSP or a pension plan, then your employer's contribution will also reduce your available room. And unlike tax-free saving, once you take out from your RRSP, the room won't reset. Now you want to make sure you record every single RRSP contribution because you don't want to exceed your available room, because if you do, there are penalties. If you exceed your RRSP contribution room, you will be charged a 1% fee every single month on this excess amount. This equates to a 12% annual fee, which is a painful pill to swallow. Technically, the government allows you to contribute $2,000 above your contribution room before you get penalized. However, this wiggle room is meant to protect you in case you make a mistake. And note that this $2,000 amount cannot be deducted from your taxable income, so try hard not to get to that point. Let's say I didn't know the limit and I add $12,000 to my RRSP even though I was maxed out. I won't pay any penalties on the first $2,000 in excess. However, I still have another $10,000 above my limit, so I will be charged 1% or $100 every single month until I withdraw the excess amount. Now you probably don't want to do all these complicated math yourself. Don't worry, thankfully CRA keeps track of this information for you. After the CRA processes your tax return, it sends a noted assessment which includes your next year's contribution limit. This notice also reminds you your unused contribution room. You can also call the CRA tax inquiry line. Just be sure to have your SIN and the previous tax return ready. Alternatively, you can register for my accounts with the CRA to review your RRSP limit, as well tracking your refund, make updates to your returns, and monitor payments. Now, if you want, you could open multiple RRSP accounts with different financial institutions if you want. You can have one with TD, one with Wealthsimple, as long as the total amount that you contribute to all your RRSPs cannot exceed your contribution limit. Any growth you earn inside your RRSP do not count as contribution as well too. Only the principal money that you put into your RRSP counts. So if you max out your RRSP and then you make another $5,000 in profits on the investments, those gains are tax sheltered unless you take it out from your accounts. Remember, the benefits of investing in your RRSP is that your RRSP contribution allow you to reduce the amount of taxes you pay right now and defer these taxes for the next 20, 30, or even 40 years down the line. And when you have a high income, you're in a high tax bracket, you can save a huge amount of money by delaying these taxes until retirement. And when your income is lower, and your tax rate will also be lower. And with that mindset, now let's take a look at an example of how you might use your RRSP. So for example, if you did a lot of overtime or receive a huge bonus this year, it's a great idea to contribute in your RRSP. And that also applies to people who earn base salary plus commission like the car industry. You had a great year, but you might foresee next year you might take a hit on the car shortage. So not a bad idea to put more in RRSP before February ends to offset your high income and take it back out when your income is low. That applies to maternity leaves too. Say Mary is pregnant and she expects her maternity leave in January next year. And because EI can only cover 50% of income, which means her income next year is going to be low and cash flow may be tight, what she can do is put a lot in RRSP this year, get more in tax return, then if she needs the money during maternity leaves, she can take it back out, and still she can gain from tax difference. Some government benefits are income related, meaning once you pass a certain threshold like the childcare benefits or the old age security, those benefits will be clawed back. So time to time, we might recommend to put more in RRSP to lower down the net income, therefore they get more government benefits while able to save for the future. And nowadays, the real estate market is hot. When you sell an investment property, 50% of the gain is taxable, and that easily can go up to 6 figures. And according to Statistics Canada, average Canadian contribute $4,000 to their RRSP, which means that there's still a lot of room left over, so it's time to use those RRSP room to offset it. And the list is on and on. The essence of the RRSP is to leverage the tax bracket difference, so please talk to an accountant or financial advisor to see if this makes sense to contribute more. Alright, so that's pretty much it for part 1. Thanks so much for watching, guys, and be sure to like, to comment, and to subscribe. If you find this video helpful, every thumbs up and comment really does help me build this channel, and I will see you guys for part 2 of the RRSP explanation. And until then,